Ricardo, for making such a great effort, I suppose, to get you connected to today's seminar. So let me begin by presenting Professor Ricardo Summa. Ricardo, apart from being a good friend, very good friend from very long time, he's a professor of economics at the University, the Federal University of Rio de Janeiro. He's also the coordinator of the graduation program in economics at the same university. Ricardo is a research fellow at the Brazilian National Council for Scientific and Technological Development, which more or less amounts to our CONACYT, our Consejo Nacional de Ciencia y Tecnología here in Mexico. And Ricardo's research interests are, well, actually very interesting topics that he is looking at. He's working on theoretical and empirical studies on demand-led growth, conflict inflation, and its relationship with macroeconomic policies. So I want to thank Ricardo for being so generous to participate in our seminar, which is simultaneously the celebration of the 80th anniversary of Investigación Económica. Let me say that Ricardo was here with us 10 years ago when we celebrated the 70th anniversary of the journal, as well as Tony Thirlwall, who also accompanied us for the same celebration. And again, Ricardo is with us in the 18th anniversary of Investigación Económica. Actually, the original idea was for Tony and Ricardo to come to Mexico. I had invited them to come to Mexico personally and give us this talk. But because of the pandemic, as we all know, which is affecting the whole world, we decided to continue this idea to have the conference online. And at the same time, this is, of course, our seminar in honor of Anthony Thirlwall for his wonderful contributions to development economics. So thank you very much again, Ricardo, for joining us. And we will proceed as follows. You will present your paper, which you already sent us, kindly sent us, and it was distributed among the participants of the seminar. And then you will have a, say, 30 to 45 minutes presentation of the paper. And then we will have a Q&A session from participants, from the public. So the floor is yours, Ricardo, and thank you again.
Well, thank you very much. I'll try to share here my screen. Okay, I think it's working now. Oh, sorry. Okay.
Okay.
Okay, so Ignacio, thank you very much for this very kind invitation. As you said, I was 10 years ago in Mexico City. The only time I was there. I really liked the seminar on 70 years of the anniversary of Investigación Económica. That time, I presented a paper on Mundell-Fleming model, which is somehow the paper I will present today is like is a development on the same paper I presented 10 years ago. The idea was that time to make a criticism to the mainstream Mundell-Fleming model. And the idea today is to have something more, let's say, more positive on how to treat open economy issues from a heterodox standpoint. And also, I'm very honored to be that this seminar is in honor of Anthony Thirlwall, which is a great reference in open economy models for the heterodox perspective. What I will do today is to focus more on the short run than on the long run, which is Thirlwall analysis. But I think that we can maybe in the discussion try to talk about how to connect this to different period of analysis. So the paper, it's a work in progress, as the paper of Mundell Fleming was 10 years ago, and it took some time to publish. It was published only in 2015, and I hope we can we can make progress a little bit faster in this research than the other. But anyway, we have something to present. It's a paper with Gabriel Aidar, which is, I think, is here. Is a PhD student at the Federal University, almost finishing his PhD, and Franklin Serrano, also a colleague at the same university. And the title of the paper is Monetary Policy in Open Economies, Exchange Rate Dynamics under Exogenous Interest Rates and Elastic Exchange Rate Expectations. So just to introduce, in this literature, there's not so much research made on how to deal with short-run open economy issues from these heterodox macroeconomic models. As I said, the literature is much more devoted to develop long-run models, as Thirlwall. If you look at, for example, books from Lavoie and Blecker and Satterfield, you see much more space devoted to this discussion. And my dog is barking, sorry. So the idea is to feel there's a lot of criticism to the mainstream view, but in our view, a not so well developed simple analytical scheme to treat these issues. We have, for example, Lavoie, a critic to the interest parity theorems, Matthias Vernengo, a criticism to the purchasing power parity, Lavoie also in 2001, a critic to endogenous interest rates due to changes in exogenous money, due to capital flows. There's this paper presented 10 years ago, which is a criticism to the Mundell Fleming model. And also there's a post-Keynesian portfolio theory to deal with exchange rate, and a lot of papers made by Harvey, which is, of course, offer a lot of good insights, but it's not so easily translated to a simple analytical scheme. So the aim of the paper presents is to provide a simple analytical scheme to represent nominal exchange rate dynamics with exogenous interest rate. And we'll try to show that exchange rate dynamics in a pure free-floating regime are intrinsically unstable, show that there are asymmetric bounds to monetary policy and other kinds of interventions. And also if you have multiple policy targets, they sometimes can be incompatible, something that Tinbergen said many years ago. The content of the presentation I'll introduce, and then talk a little bit about the balance of payment or exchange rate market, then how the mainstream close this simple model, and how we propose an alternative way to close this model, to talk about exchange rate dynamics and exogenous interest rates. Okay. Well, I will start with the balance of payments equation, which is equal to 0, and you can divide between current account, capital account, and financial account. The financial account is also divided into long-term flows, short-term flows, and change in official reserves from the central bank. And we will treat all of these long-term flows, change in reserves, and current account and capital accounts first as exogenous, as we're thinking in a shorter period of analysis. And we will treat the short-term flows as determined by the interest rate differentials between the countries, the interest rate, and the international interest rate. And we add to this international rate the sovereign spread and the expected exchange rate change. This is a very basic equation which will change some assumptions and make different closures to analyze all the possible relations. So this is a very big equation, but the idea is that the short-run flows are related to this interest rate differentials, in the sense that if the interest rate differential is higher, you have more short-run flows. If domestic interest rate is higher than international, you have short-run flows. And this will, when you put all the other flows, which are treated first as exogenous, you have an equation in which the exchange rate is the endogenous variable. So the exchange rate will adjust to close this very big equation. So the other, also at the first time, the expectations are given, both domestic and international interest rates are exogenous, and also the sovereign spreads. We can rearrange this equation. Both equations 5 and 6 are the same. I just arrange in the equation 6 to make clear that the nominal exchange rate will be related to all these flows and variables that determine the short-run flows. Okay. And of course, if you have zero variation of international reserves, we are in the case of the pure flexible exchange rate regime. And if you don't have a fixed exchange rate regime, you are in a dirty floating, as we will talk more later. These alternative approaches will depend on the assumptions, as I said, concerning the exchange rate expectations, the relevance of long-term flows vis-a-vis short-term flows, which is captured by this parameter. I think it's gamma. And finally, the determination of the domestic interest rate. How the mainstream approach and the uncovered interest parity see these assumptions. And there's the idea that there's perfect mobility and also perfect substitutability of capital in the international capital markets, which means that very small difference between interest rates bring massive amounts of capital flows, which in our basic equation, this means that this parameter, I think it's gamma, is tend to infinite. And also, as we have perfect substitutability of capital, also there's no sovereign spread. And if you replace these two assumptions on the equation 5 or 6, we get into this UIP relation, which connects domestic and international interest rate and nominal exchange rate and its expectations. So there's two ways you can think. One is that exogenous, that domestic interest rate is exogenous and expected exchange rate is given. In general, it's given by other assumptions, like, for example, purchasing power parity. And then the spot exchange rate becomes the endogenous variable. Or if you are in a fixed exchange rate regime, and then the nominal exchange rate is fixed and the expectation is given, the domestic interest rate will become endogenous through this mechanism of flows and changes in the monetary base and changes in the nominal interest rates. Okay. The problems with UIP, I will not take so long here because there's a very documented literature on empirical failure of the UIP. Lavoie is one example that makes a small service, but there's a lot of papers talking about this. And besides the empirical problems, also in general, the expectations of exchange rate are explained by the purchasing power parity, or that the agents have rational expectations that purchasing power parity will hold.
Eso es un bien de capital que le está emitiendo un extranjero, una empresa extranjera, un capital extranjero.
There's someone. Also, Lavoie shown that the combination of the purchasing power parity with uncovered parity implies that the real interest parity theorem is valid, which means that all the real interest rates must change together in the world, which Lavoie also showed that this, in a simple exercise, is not the case. And also, there's also some other criticism to the purchasing power parity, for example, by Matthias Vernengo, from a theoretical perspective. So we will move from this view and try to change some assumptions and see what will happen to the model. The behavior will be different. So the changes we made in the assumptions, the idea that the international capital market is imperfect, both because you don't have perfect capital mobility. Sometimes you can have a legal or other impediments to capital mobility, but also, and maybe more important, because the assets are not perfect substitutes. International cap assets are not perfect substitutes each other, and also this can reflect a lot of imperfections in the international capital markets. So this means in our simple equation that the parameter does not tend to infinite, and also there's some sovereign spread, positive. Second, we introduce the idea made by, the very general idea made by Hicks, that expectations are elastic in the sense that they depend on past values of the variable. In this case, the exchange rate expectations will depend on past values of exchange rates. And finally, we will consider that domestic interest rate is exogenous, and there is no automatic mechanisms from changes in exogenous money, for example, that can change the domestic central bank set. Okay. The idea of the elastic expectations of exchange rate is we use a simple adaptive expectations just to make the most simple possible way to show the results, but of course we can also include shocks or other, as it will show in the expectations. But the idea is that even if you have some exogenous expectations on exchange rate, you will correct it with the past observations. This is the main idea we want to tell. For just to simplify, if you assume that expectations converge to the exchange rate that happened in the one period before, which is the simple way to close the model for these very naive adaptive expectations, we will have that the exchange rate dynamics will depend on the past value of nominal exchange rate plus all these flows and the interest rate differentials with the sovereign spread. We have some results here from this simple change in the assumptions. The first is that the exchange rate does not necessarily converge to a long-run equilibrium given by the expected exchange rate. For a given shock, the exchange rate changes over time. I will show a graph showing this figure. And there's no natural exchange rate in this sense, but rather I will see a policy choice of the monetary alternative given by the constraints of the international liquidity, the current account situation, and other variables, international variables. This means that the free floating, if you consider the change in reserves equal to 0, can be very unstable in the sense that there is only one interest rate possible to close the model, and all the changes in these flows, which are in the international interest rate and spread, etc., can deviate the model, and then the central bank has to change a lot the domestic rate to try to stabilize this pure floating regime, if it's the case. Of course, if this equilibrium interest rate is not achieved, you have or a permanent appreciation of nominal exchange rate or a permanent devaluation. And this, we made some very also simple simulations here to show that here, if the interest rate is too low, you face a process of exchange rate devaluation. If the interest rate is too high, you face a process of appreciation, evaluation. And also, if the effect of the shocks I mentioned is to change the level, but not to stop the process. So you need to change the interest rate to do this if you are in a pure free floating regime. So what we conclude that if this is the case and the exchange rate is very important for a lot of different results in the economy, for example, can change distribution, can lead to financial crisis if the firms or families are indebted in foreign currencies, can affect inflation, a lot of other variables. The idea, remember Calvin Heiner, the fear of floating, is that in the end, the monetary authority will avoid to establish this pure free floating, and will also try to change reserves to stabilize the exchange rate. So here, if we include in that equation the target a target for example, a minimum nominal exchange rate, you have to set the interest rate and or to accumulate reserves. On the other hand, if you have a maximum nominal exchange rate, the central bank has a maximum exchange rate as a target, the central bank also can set the interest rate, but also must sell international reserves to guarantee this. So these are the constraints the central bank will face if wants to avoid this unstable exchange rate regime. And of course, it's much easier to accumulate reserves than to sell reserves, which are finite and can finish and lead the economy back to something a pure free floating regime, which in general, as we know from experience, are quite drastic. The devaluation that happens when the central bank lose all the reserves and cannot manage to control exchange rates devaluations process. Okay. Also, the sovereign spread we treated as exogenous in the first instance can also depend on international conditions. For example, Gabriel Aidar and Julia Braga published a paper in Investigación Económica, which an empirical paper which emphasized the predominance of international conditions determining the sovereign spread, which means that international financial cycles will affect the spread. Also, Helen Ray published a paper which call attention on the fact that also the interest rate set by the Fed, by the US Central Bank, affect international conditions and all the sovereign spreads around the world. So what I add here is that the asymmetric bounds become even more complicated in the case where, for example, the Fed increase interest rates, which will also increase the sovereign spread and will worsen the international conditions around the world. It will be harder for domestic monetary authorities to avoid a depreciation than on the contrary, when the Fed decreases the interest rate, all the sovereign spreads decreases and the conditions get better. So this we can add in our model all of these more realistic assumptions on these issues. Finally, there's also a huge literature on the role of forward markets and how foreign markets can change the control monetary authority can have over the spot exchange rate or over the interest rate, etc. And there's also this literature on the covert interest parity. And there's some people that thinks that the fact that you have forward markets and if you have different if expectations are different than the forward exchange rate, you can have some sort of speculative attacks. But we show in the model that the forward markets brings, and also this point was made also by Lavoie in 2000, that the forward markets bring no information about the spot exchange rate, but only on the difference between the spot and the forward exchange rate. So the way we think we can include the role of forward markets in our model is that forward markets reduce the cost of speculation, as you don't need to borrow in the spot market, but you can only have some margins to pay if in forward contracts. And this increased the role played by short-term flows in comparison with the long-term flows, which in our model which means that we have a higher parameter, lambda, in the model. If you have a very deregulated forward markets that can increase considerably the possibility of speculation. But brings no new information about the nominal exchange rates, as these markets are linked by arbitrage. Okay, I think I'll finish and we'll have some time to discuss. Only one final slide. The final remarks that UIP is the result of this assumption of perfect mobility, substitutability of capital and exogenous exchange rate expectations. If you assume that capital mobility is imperfect, also there's no perfect substitution or no perfect international financial markets, and exchange rate expectations are elastic in the sense that depends on the past values of exchange rate. We provide a simple alternative framework that can be used in short-run macroeconomic models with exogenous interest rate, combined with exogenous interest rate. Exchange rate dynamics in a pure free-floating regime can be very unstable. The monetary authority can set the domestic interest rate, but faces asymmetrical boundaries. Other forms of intervention are also important. There's a recent paper by Frankel called Systematic Managed Floating, which means we are thinking with this term that the central bank systematically influence the exchange rate with interventions in the spot, in the forward market, and also by setting the domestic interest rate, which must be taking account the international variables. And that's the multiple policy targets sometimes can be incompatible. And this, I read, we did not put in the paper, but it's an extension, I think. I work a little bit on this, but I think you can go forward with this after finishing this paper, that to include also inflation target, which in the end depends on the exchange rate dynamics, and then the central bank with inflation targets will be even more. We have more boundaries, more constraints to set the domestic interest rates and achieve the target. Okay, I'll finish. I'll thank you very much, and we now can discuss. Thank you so much. I stop sharing.
All right. Thank you very much, Ricardo, for such an insightful and provocative paper. I think it was a clear presentation and very representative of the paper that you generally sent us. And of course, the exchange rate is a very important variable. And it's perhaps one of the nightmares facing central bankers and monetary authorities in general, because it's such a complex, variable and very difficult to deal with. And I'm sure my colleagues in the room have important questions to raise. So I open the floor for questions from the participants. So you are most welcome to raise your questions, please. Who wants to start? So we have about 100 people in the room. So I think you have a nice audience. You have addressed a nice audience, Ricardo, and I'm sure there will be questions. So it's just a question of breaking the ice.
I'll break the ice if you like.
Please do so, Tony.
Okay. So thanks very much, Ricardo, for the presentation. I'm trying to think about what you're saying in relation to the sort of real world in which we live, which is a world now where very few countries have complete, and very few countries have freely floating exchange rates. So we're in the middle in most countries with dirty floating. And in the dirty floating regime, everything basically becomes endogenous. Because take the case where you have a balance of payments deficit. So the exchange rate is allowed to give a little bit. But the monetary authority or the government is not indifferent to what the exchange rate will be. So then you get the interest rate starting to rise. And I mean, the interesting question then is to what extent you allow the interest rate to rise and to what extent you may use reserves to stop the depreciation. And I would have thought empirically it would be interesting to do some empirics to see exactly what the relationship is between countries getting into balance of payments problems, how much they allow the country to depreciate, to what extent they raise interest rates as a response to that, to what extent they use reserves. So I'm asking really for some empirics.
Okay.
The theory is fine, maybe, but what about some empirics?
Yeah, I don't know. We didn't include empirics in this paper as it's quite long. And as Ignacio said, it's a complex variable. So this is why it took so long to try to simplify this, just to see how you can connect each variables. But of course, there's a big empirical literature on this. For example, Helene Ray has some papers on this interdependence of interest rates, and there's also some, this is called the dilemma, and there's also others papers trying to check if there's some asymmetry, if for example the Fed increases the interest rate, if the countries respond more than when the Fed decreases. The idea is that it's not automatic, but of course it's more difficult to not increase the interest rate if the international interest rate increases. But on the contrary, when the U.S. central bank decreases the interest rate, this opens some space for emerging economies, other economies, to decrease the interest rate and to make more expansionary policies, like monetary policies. So this is something that some papers found. There's this interdependence, but they do not behave the same way. But of course, I think one lesson from this empirical evidence, which I think we are trying to summarize in the paper from a more theoretical point of view, is to keep this idea that you have some boundaries, you have some constraints, and you have interdependence, but not automatic mechanisms that change the interest rate, as for example in the Mundell Fleming model or other models. So the interest rate is exogenous, but as the central bank has other policy targets, sometimes if the central bank wants to achieve the target, it will not possible to set the interest rate whenever the central bank wants. But yes, of course, I think this is a very interesting way to move forward. If someone wants to keep this research to see if there's more response in the interest rate or in the change in the international reserve. I think it's very interesting point. I don't know. I never saw a paper discussing this, the importance between these two, but I think it's very interesting to explore. Thank you so much for that.
Just one, if I can just ask one short question.
Go ahead, please.
Just a short question about, in your model, you say that in the freely float exchange rate system, there could be, I forget the term you used, unstable. Does that mean in your model that speculation could never be stabilizing?
That's true. Yes.
As opposed to Friedman.
Yeah, because I was going to
Opposed
say.
to Friedman. Yes. I think Caldor was more contrary to Friedman in this point, no, on speculation, on the instability of speculation. In this paper, I think 1939, Caldor's paper.
Yeah.
But Caldor and also Baumol has a paper on speculation, and they call attention to difference between goods which you can produce, and then you can stabilize if, for example, the price goes up, and then you produce more, and then you can revert the speculation. But financial assets or these policy variables like exchange rate is more difficult because they are policy variables. You cannot produce more exchange rate. This, I think, is very interesting to remember this paper. Thank you so much.
Yeah. Okay. Any further question? More questions?
I make three considerations, Professor Perrotini. Mario Duran.
Yes. Go ahead, Mario. Hello.
First, foreign exchange markets is not explained for the balance of payments flows. There are financial forces that operate in that market. This is the first consideration. The second consideration is the next. Financial variables are not determined at any natural level. And the third consideration is the actual process of the production of money in its different forms is inherently a source of power. The paper and the model presented for Professor Summa is very interesting to me from the point of view of these three considerations. Thanks.
Okay. Any reaction, Ricardo, on these comments?
I think I thank for the considerations.
Okay.
Yes, I think the first consideration about the role of forward markets, I just add that they are important for generating liquidity in international markets, but they don't add new information. We don't say that they are not important at all, but they have sometimes more limited importance than in other models that believe that these markets are brings new information.
Okay, so we have one more question from Aida from England. Okay, Aida, go ahead, please, from across the Atlantic.
Thank you. So thank you, Ricardo, for the presentation. I think it's a brilliant one. I really like the theory that you're presenting, and actually I think, looking at the Mexican experience, I think is, if we are looking for the empirics, is a very good example. I remember that in the Bank of Mexico had like several regimes of foreign market intervention. And then they even have these caps, as you wrote in the presentation, with the max and the minimum deviation of the exchange rate, which there were important for controlling the interest rate in the 1998 and 2008. So, probably you can have a look at Mexican case. And for the questions, I was thinking in what you comment about Helena Ray and the work on the global financial cycle, and how much do you think it matters for the determination of the interest rate and the spread, and which one is more important? Because it seems to be that there are two, or at least two, mechanisms of transmissions. And the final one is on the on your last line on the incompatibility of targets. So the new literature in the advanced economies after the global financial crisis is on the idea of macroprudential policies. Emerging markets use it since a long time ago, right? So do you think is that a way to go, or do you think with this theory would not be compatible? That's it. Thank you.
Okay.
Can I respond?
Yes, please. Go ahead. Yes.
Thanks so much for the comments on the Mexican economy and for this very interesting question. Yes, I think I like the empirical part of Helena Ray paper, but I interpret a little bit different than her, the same evidence. And this model is a way to think about these relations between international rate, sovereign spread, and domestic interest rate. I think, and not in the most famous paper by Ray, which is this one in 2015, but there's another, I think 2016 or 17. And in this paper, she says that as the idea that you have in both papers, she said there's a dilemma in the way that you cannot control your interest rate. And as this literature on the trilemma is based on the old Mundell-Fleming model and the idea of exogenous money, and that the capital flows change the monetary base and endogenously change the interest rate. But now we know that the central bank sets the base interest rate. The central bank influence the long-term interest rate with the policy, with the path, the open mouth policy, where the base rates will go. So it's difficult to think which is the endogenous mechanism that can force the central bank, not for the central bank, that the central bank will lose control on the interest rate. So the idea is that the central bank can have control and can set the central bank can set the interest rate whenever wants, but can do a lot of bad things to the economy, can generate hyperinflation, can broke the firms, can can have very bad impacts on income distribution. But of course, as the central banks around the world in general has inflation target, which inflation depends on the exchange rate dynamics, and as you have these constraints, the idea is that when the way we think with this model, we interpret her results, her empirical results, is that, yeah, I believe that when the U.S. central bank changes the interest rate, it affects all the spreads, the sovereign spreads around the world, which is the capacity to pay in foreign currency. So the international conditions become worse for the countries that do not issue the dollar, let's say. And this will force, both because the Fed is raising the interest rate and both because the sovereign spreads and the conditions are becoming worse, will force the central bank to react and to change to exogenously change the interest rate. On the other hand, when the international conditions go on the other direction, it opens space for central bank to decrease the domestic, but it will not be forced to decrease. So this is why maybe in empirical you can see different responses from different central banks when Feds change the interest rate, because there's no automatic mechanism. I think this is the idea I want to pass with the paper and how we interpret these results. I don't know if I make a little bit more clear or not.
Yeah,
if I answer your question.
Yeah, thank you. And if you could comment on the objectives and the Timbergen thing with the macroprudential policies.
Sorry. Yes, this is if the central bank has, for example, an inflation target, or has a minimum, a maximum exchange rate, and a maximum amount of reserves the central bank wants to sell, maybe this can be incompatible. If, for example, the Fed raised the interest rate, you have inflation target, you don't want to lose too many reserves, you don't want the exchange rate to be so high, also because it will affect inflation. So maybe you want to do expansionary monetary policy, but okay, you can set the interest rate, but you not achieve the other targets. So this is a bit of the idea. You have not so many instruments, and the interest rate is one of them. I remember you asked about macroprudential policies, and you have no much room to deal with all the targets you impose. So maybe you ask if you can do macroprudential policies. Yes, I think can be one way to for example, you want to make monetary, expansionary monetary policy to increase credit in general to household, I don't know. But the Fed is increasing the international rates. Maybe you can try to lower the spreads of of course, not so easy then to make like a meeting of the committee and to change the base rate. Of course, much more difficult and I think maybe I don't know too much about macroprudential policy, but seems to me that it's more easy to make contractionary, to contract credit than to expand. I'm not sure, but maybe it's easier to make more difficult to have access to credit than the opposite with this policy. But okay, maybe I'm wrong, but I think you have some room. If the base rate's too high, even if you reduce the spread to household or to residential investment, etc., it's a spread on the base rate or the base plus the expectations on the long-term rates. So it's you have some not so complete, but you can do something. I agree.
Okay. So, Ricardo, there is one more question from Juan Carlos Cortez. He asks you, what do you make of the Brazil Central Bank monetary policy during the pandemic, the COVID-19 pandemic? That is one question. And the other one is whether you consider that a variation of the real, of the Brazilian currency, is required for the management of economic policy in the present year in Brazil, as far as I understood his questions.
Sorry, could you please repeat the first question?
Yeah, the first is, what do you make of the central bank's policy in Brazil facing the pandemic?
Okay. So the case of Brazil, I think Brazilian real was maybe one of the currency that faced the highest devaluation in this since the pandemic. And I think, of course, the pandemic changed a lot of things, no? And also brought about a lot of uncertainty to what will happen, and this affect all the developing countries, and also with changes in exchange rates. But together with the pandemic, the central bank lower, in my view, too much the domestic interest rate here, and the exchange rate, even now that things are becoming better, that commodity prices are increasing, that you have somehow some return to international trade, etc. Even with, okay, it's okay that you have a huge devaluation in the beginning of the pandemic, but 1 year after, we are still facing devaluations in our currency. We are in that graph, no? In the second graph I show, with a process of devaluation, of course, with some shocks. Only now that central bank start increasing the interest rate, and you have you can say, I don't know if it was just only for this announcement that the interest rate will keep increasing, but we have in the last month some value appreciation of the exchange rate. So the results, inflation is higher than the target. This, I think maybe you in Mexico suffer the same as us here. When you have this strong devaluation, also real wages falls. So this small recovery we had in the last quarters in 2020, which was much more, I think, due to the fiscal policy with transfers from poor or unemployed people, which was quite huge. And then this helped the output to recover a little bit from the very fall in the second quarter, but the consumption is now slowing down because they've stopped this fiscal policy. They stopped to transfer money in January. Now they return, but in a much lower program than before. And I think one of the reasons are of course the fiscal policy, but also the effect of the changes in exchange rates, the maxi devaluation on real wages and then on consumption. I'm not sure if I respond all the questions.
I think so. I think well, Juan Carlos raised these questions. I don't know whether he's satisfied. So any more questions? Any further question? If there are no more questions.
Oh, sorry.
Yes.
May I?
Denise? Yeah, Denise,
yes.
Go ahead.
Please.
Yes, Denise, go ahead.
Thank you. Well, firstly, I would like to say thank you for all the information you gave us. It was really, I don't know, I felt like I was having this real good talk with you, like you when Mike and I were talking. But first, well, secondly, I would like to say sorry in advance if I'm getting it wrong, but historically, the floating exchange rate became more popular after the failure of the gold standard and the Bretton Woods Agreement. And the question is, which event do you think could embrace or miss out the floating exchange rate? And do you think the pandemic and its evolution could be one of these events? And if it is, which effect would it have? Maybe not talking about a specific market as Brazil or Mexico, but in general.
Okay, let's see if I can respond. I think in Bretton Woods you have this more regulated capital flows between mainly European and European countries and US. Somehow an agreement to keep fixed exchange rates with some possible devaluations, but must be negotiated between the countries, etc. And there's no capital flow, short-run capital flows as we have now. So it was easier to have fixed exchange rates. And then I think there's when with the end of the Bretton Woods, you have this more this system based on the dollar, the role of the dollar as a main currency, and all the countries trying to adapt to. I think there's a sentence. I don't remember. I think Secretary of Treasury of U.S. in the 80s says that the dollar is our currency and your problem. So, of course, it's not perfect free floating because the countries react. Even the dollar is not free floating because exchange rate is a measure of one currency and another. And if all the other countries react, the one country will not have pure free floating. So, but I think in the 90s, some countries try to return to the fixed exchange rate regime, and I think, like for example, in Argentina, and it was much more difficult to manage this regime, like a developing country with capital flows, short-run capital flows, much more deregulated. And you know how things end in Argentina, and it was not very good. And other countries also try to somehow fix the exchange rate. Brazil somehow, then it was quite difficult, then start manage floating. But in the 2000s, I think it's much more difficult to find in emerging countries this kind of commitment to fixed exchange rate regimes. And also, I think one difference in the 2000s is that the countries let the exchange rate float a little bit with some management, and due to both the very low interest rates around the world and in the US and around the world, and with China growing very fast and commodity prices rising, all these countries, if you see what happened with the international reserves in Brazil, in Russia, in China, and all the countries, it increased a lot. In Thailand, in Korea, in all the countries. I don't know if all. No, I think Argentina didn't manage so well to accumulate reserves when the condition was better. But I think the way the countries and I think the 2000s and also now 2010 are much better in terms of external constraints, for much better, no? In terms of relaxing external constraints for our countries than it was in the 90s. And it was, of course, there's both better conditions in the financial markets and in the good markets, in the trade. But also, I think all of these countries managed to take advantage of this by making free floating, not committing to a fixed exchange rate regime, by accumulating a lot of reserves. And this, I think, also had let's say, kind of externality, because if you don't have a crisis in Russia, then in Mexico, then in Brazil, then in Argentina, it's better for the whole set of countries, of developing countries. This, I don't know if I answer your question, but
yes, thank you very much.
Something more, not so related with the paper, some more.
Yeah, of course.
As you asked.
Sure. Yeah, I think there is one more question from, I don't know who was also trying to raise a question. I just heard some voice. Now this is the opportunity. Yes, Benjamín, please. Benjamín, go ahead. Your mic is closed. Your mic, open your mic.
Yeah,
yes, okay.
Quite happy actually for the presentation given by Ricardo and his associates, Gabriel and Franklin. Following the same step of Juan Carlos Cortés, in the sense to try to carry the analysis to the economic policy, which now is trying to, all over the world, is trying to get the right combination of fiscal and monetary policies to look for the way out of the pandemic crisis, only one of the interlocked crises we are facing in many countries. It's quite clear that the essence of the paper, that the goal is to propose an analytical scheme representing the exchange rate dynamics that can be used in heterodox macroeconomics modeling. So the aim of the paper, from my point of view, is just to foster the theoretical foundation of economics heterodox from one quite academic, quite theoretical basis, as I said. But thinking in that think about how we can enlarge, force the conclusions, you know, the so-called by you all closures, a distinct step, a distinct number of assumptions. You all said, we also saw page 33, we also saw that the international liquidity conditions and the economy's external balance establish a floor, you see, a sort of backstop in economic policy to monetary policy, which determines asymmetric bounds to monetary policy. Well, what will your opinion, your answer? The thesis or the point of view which is acquiring a large consensus in our guild of economics, that the problem with monetary policy is in this sense. The world is facing solvency problems, nor liquidity problems, because you follow up saying there is no convergence in the long term exchange rate of equilibrium given by exogenous and volatile expectation. What your point of view will be before the people, before the thesis or the hypothesis saying we are living a solvency problem rather than liquidity problems. And no liquidity problem because there are many financial resources in the world economy, because the quantitative easing, for instance, and so on and so forth.
Thank you, Benjamin. Yes.
Okay.
So please, Ricardo.
I will try to respond. I think in terms of solvency, you mean external solvency, or I can think in two ways of solvency. Or the idea that you don't have, for example, you have external debt denominated in foreign currency, and for example, the central bank has no international reserves to sell, and you don't have access in the international market to pay for this debt, or the conditions are so bad that you can have, and then you cannot pay your debt like this. From a country, but also I think you can have solvency problems within the country, and the idea that, of course, exchange rate and interest rate can have effects on the solvency of indebted enterprises or households, etc., workers. But I think it's the first one. No, I think yes. This is interesting. I don't know if I can answer exactly your question, because I think some part of the flows that create this kind of solvency problems are the one that must be paid on domestic currency. But other flows, for example, if someone buy some non-resident buys a treasure by the Mexican central bank, paid in peso, in the domestic currency. This means that there's no dissolvency problem due to external conditions. So I think what you're saying, that in the same balance of payments we are using to analyze exchange rate dynamics, you cannot have so many conclusions about the solvency of the external conditions, because it will depend on the shares between when you are indebted in foreign currency, or if you are receiving foreign currency by selling domestic assets. I don't know if I respond, but I think you cannot have some so systematic. With our equation, I don't think we can expand and have some conclusions about solvency problems.
Thank you very much.
Okay.
It depends
Yes,
also on the international reserve and other, yeah. I think must
okay. I don't know if there is nobody else trying to make a question. I would jump in and make a couple of questions for you, Ricardo. Well, the first thing, I found very interesting your argument with regards the constraints of monetary policy in your model, you know. But I was wondering whether in your model you are assuming that the exchange rate dynamics refers to a currency that works as a medium of exchange and also as a store of value, or if you allow for currencies which domestically can function as an exchange, as a medium of exchange, but not as a store of value, which is the case of most emerging market economies currencies, which of course work in the domestic markets as a medium of exchange, but to a much less extent as a store of value. And the very fact that central banks are compelled to accumulate international reserves simply confirms the fact that the domestic currency is not working as a store of value. So what will happen in your model if you allow for these different kinds of currencies, which may function as a medium of exchange, but not as a store of value? Would that impose more further constraints on monetary policy? That is one issue. And the second point, towards the end of your paper, you make the case for the difficulties of having multiple policy targets, which can be incompatible. Well, I would argue, yes, of course. If you have, just one policy instrument or a limited amount of policy instruments, multiple policy targets can be incompatible. And that was exactly the case put forth by Jan Tinbergen. In order for you to achieve simultaneously all your targets, you must have the same amount of instruments as targets. So I think then the questions arises as to the problem is not so much whether you can have or not multiple policy targets, but whether you can in fact have multiple policy instruments. And I think that is the case, the problem facing most emerging market economies. These are the two questions I wanted to raise for you.
Thanks, Ignacio. You told you was my friend, but you make very difficult questions for me. Okay. Well, the first I think it's a very good question, and I'm not sure. I believe we can include in the model the same way as we include forward markets, in the sense that you amplify the possibility of liquidity and speculation, and you can change the parameter. I mean, if I get right what you're saying, like some countries that are somehow dollarized,
right?
No. Yes, I think maybe it will increase the importance of short-term flows in relation to long-term flows, and the parameter, and this can make more difficult to monetary policy, to the autonomy of monetary policy thinking in this sense of having room to make expansionary policies depending on what happened in the rest of the world. I think so, but I'm not so sure. But that's a very good question. I think maybe we talk a little bit with Gabriel. I don't know if Gabriel is here. Maybe if you allow, if Gabriel Aidar can talk a little bit about this, and I think it will be good. And I think your second question, I agree. You have not so many instruments in relation with the targets you have, and sometimes even the targets can be quite unrealistic.
Right.
Like, for example, you want to have an inflation target of 2%, but there's a pandemic and the exchange rate devaluate like 30%. Okay, you can have the target, but you not achieve it, no matter how you increase the interest rate or etc. So I think both. I think I would just add to what you said, this point. Also, you have not so many instruments, and sometimes the targets are not so realistic. And sometimes because if you compare with, for example, the new consensus model, the external, in general, the external conditions are neutral to inflation, because we have all these theorems, and inflation will not depend on the exchange rate. And you can always achieve the target if the interest rate is equal to the natural rate. No. Of course, if you open the economy, you have international real natural rate, given by this real parity theorems, but you can achieve the target. Just set the rate to the natural. And what you talk and I add, sometimes you cannot achieve inflation target, or because of things are external conditions are not neutral to inflation, to distribution, to output, etc.
Okay.
But many thanks for the question.
No.
I think we have to think. I don't know if Gabriel is here, if he can.
Yeah, I saw Gabriel here, so he must be.
I am, but Summa, you answered. I agree with your answer. I think it's
okay.
Well,
yeah, we talk a little bit.
I think anything regarding speculation in our models captured through the gamma parameter.
Yes, and we talk a little bit about this to prepare for some possible questions, because here in Brazil they are deregulating the exchange rate market and moving in the direction you're saying, in the direction you think there's no the domestic currency is not a storage of value, and you can keep you can yes, the move is in this direction, and I think goes in the same way. Yes.
Yeah, I mean, just one point. I mean, the first questions I raised, of course, is directed to whether, this distinction between a currency which is both medium of exchange and store of value, as opposed to a currency which is only a medium of exchange but not a store of value, perhaps bears some influence on the gamma parameter. But not only that, I think that would also have to do with what happens with the rho parameter in your equations in terms of the risk involved, I mean, in the country risk capture in the exchange rate fluctuations. Yeah? And finally, since as we discussed long ago, this paper is meant for Investigación Económica, perhaps in the final version, you guys would like to elaborate on these issues for the sake of completion. That's it. So I don't know whether there is any more questions. I mean, oh, Hideo is there, ready to make a question. Go ahead, Hideo.
Thank you. Ricardo, I would want to ask someone, what happened with Brazil? I have a friend that make analysis of countries in Latin America and the United States and so on. And he sent a graphic of the last 15 months. I will share this graphic here. Okay. In this graphic, the Brazilian real brasileño, or real brasileiro, is very, very bad in exchange rate devaluation. So what is the main reason or main point that Brazil is so bad compared to any other country? What is your opinion? This cause of this situation, or what is provoking this kind of situation?
Yes. So I think thanks for the question, and also for illustrating the point. Yes. I think, as I said, Brazil decreased the interest rate heavily during the pandemic. And I think the interest rate differential is negative if we include sovereign spread, etc. And also you have this speculation dynamics. When you have a strong devaluation with negative interest rate differential, this process goes. So I think, and now central banks start increasing the domestic interest rate. And okay, the problem with exchange rate is it's so volatile that maybe today I say something, or maybe there's a trend of reverting and now I think for the last month it appreciate a little bit, and there's this trend of appreciation. Of course, tomorrow everything can change, but I think there's only 2 episodes in Brazil in which the central bank set the interest rate above, below this international rate plus the spread, which the first one was in 2002, some months before the election of Lula. And in that time there was a huge devaluation, but it lasts for not so many months. And that time, I think the conditions were worse. International, there's crisis in Argentina, in Uruguay, in Russia, all the countries, 2001, 2002. But now it was the second time that we did not. It lasts for a long time, since I think, I don't know exactly, but I think since the beginning of the pandemic, the central bank keep the interest rate lower than the international plus spread. So I think this is the main cause, in my view. Of course, in the beginning, all the countries suffer from the pandemics, as you show in our graph. But why we suffer more than the others, I think this is the difference. I think I'm not sure. I think Turkey raised heavily the interest rate, or other countries try to avoid this devaluation. And now, in that time, our Ministry of Economy said, no, there's no problem with huge devaluations. This was a thing that happened in the past. There's no problem with inflation. As at that time, the commodity price also fall, that's fine, because the commodity price fall and the interest rate, the exchange rate increase, and then you didn't have so many impacts. But when exchange rate keeps devaluating and the commodity price starts increasing again, now we are facing a much higher inflation.
Okay, all right. Any more questions? We still have room for one more question. No more questions. Okay, well, I think this presentation has come to an end. It's been very fruitful, very interesting, thought-provoking, and we have had a profound discussion, Ricardo. So many thanks for giving us this very rich paper. And I'm looking forward to the final version of it for Investigación Económica. And of course, we will continue in this seminar. Next presentation will be Professor Heinz Kurz from Graz University, Austria. He will be presenting a paper on Max Weber. I think it's going to be a very interesting paper, because he will show that Max Weber, who is known as a sociologist, but he was originally an economist, has a lot to do on development economics. So we will have another very interesting paper coming up. So thank you very much, Ricardo, again, and thanks Penny and Tony and Aida for joining us from long distance across the Atlantic, and for staying awake so late at night, which is very, I think it's not easy for you at this time to be listening to a presentation. Fortunately, it was a very good one. So thank you very much. Thank you, Benjamin. Thank you, Hideo. Thank you to all of the participants on this occasion. And I'm sure we have had such a very, very important, interesting presentation on behalf of Ricardo. Ricardo, please, and Gabriel, please say hello to Franklin, and of course also to Fabio from my side. Thank you very much, and I hope to see you soon in the near future. Okay, bye now. Good night.
Thank you.
I don't know whether Benjamin or Hideo want to say something. Benjamin?
I want to say thank you for this presentation. Yes.
Benjamin? Your mic is closed. You must open your mouth, mic.
To reiterate our gratitude to Ricardo, Gabriel, and Franklin for their presentation. Actually, it offered a very nice atmosphere, a frame to carry on with our seminar on development economics issues which in this year, in this semester, we dedicate, as Professor Perrotini already said, to Professor Anthony Philip Thirlwall in appreciation for his huge, varied, transcendental contributions on economics of growth and economic development. Many thanks, Penelope, also for allowing us, you see, to get communication by this way. It couldn't be final word. It couldn't be the topic chosen by our college, the Brazilian college, because it's quite timely, because their dissertation, Ricardo's, on behalf of the rest of the team, is addressed just in one point of time in governments try to design the right combination, has already said in my intervention, of fiscal and monetary policies. The time is difficult, as Charles Dickens used to say in his novels. In what sense? In the sense that the world economy is in the grip of a list of 3 interlocking crises. First, the coronavirus pandemic with its huge economic fallout. Secondly, the creeping maze of slowing growth, rising inequality, and thirdly, the climate change. I mean, the effects are imposing on the top of the pandemic for the meteorological disorder, natural and disaster because of climate change. Thank you very much, all of you.
Thank you, Benjamin. So with this, we come to an end to today's presentation. So